Hi there. My name is Victor Louis, and I'm the head of investment advisory at Sankore Global Investments, and this is your weekly financial market update. We start off in the US markets, where stocks closed lower last week as concerns around the state of the US economy weighed on investor sentiments, with several macro reports actually coming in weaker than expected, with also policy uncertainty from the Trump White House remaining a challenge. Walmart's lower than expected revenue guidance for its fiscal year 2026 was another major point of concern. We also saw reports, that's the University of Michigan Consumer Sentiment Reports, which indicated that US consumers were preparing for high inflation due in part to potential tariffs, and this has put one-year inflation expectation at 4.3%, significantly higher than the 3.3% that we had seen last month. So on Friday, the S&P lost 1.7% for its worst day in 2 months. The Dow shed 748 points, while the Nasdaq was down 2.2%. For the week, the Dow lost 2.5% for its worst week since October. The S&P was down 1.66%, whilst the Nasdaq shed 2.51%. Going into the new week, really, market will be looking to some key readings on the corporate and also on the macro front. We expect to see earnings report from Lowe's and Home Depot come out on Tuesday. I mean, this should give investors a better sense, really, of how consumers are faring and how they are coping with the price situation in the economy. We'll also be seeing NVIDIA's report on Wednesday. This will be its first report, really, after the emergence of DeepSeek. And investors really will be looking for clues and indications as to the sustainability of the AI trade. Thus far, Q4 2024 earnings season, about 77% of S&P companies have released their results. About 76% of them have reported a better than expected EPS situation, while just about 62% have reported better than expected revenue. We'll also be seeing the PCE data for January on Friday, which is the Fed's preferred gauge, for inflation. So really for this week, it's really going to be about earnings and also the macro situation. But I think that a lot of focus will really be on that earnings this week, particularly NVIDIA and, what we're going to see from Home Depot and Lowe's, especially against the background of what we saw with Walmart, last week. Over in the UK, inflation, increased really much higher than expected to 3% for January. This was higher than 2.8% that analysts had expected. Core inflation rose 3.7% year on year, higher than the 3.2% that we had seen the previous month. And this January's print is the hottest annual print or hottest annual rates since March of last year. I mean, inflation fell lower than expected to 2.5% in December. So this sort of jump that we're seeing is really, really strong. And this sharp rise could present a challenge to the BOE's instance. If you recall, on the 6th of February, the BOE cut rates for the first time this year, and for the first time in quite some months, just on the back of the fact that the economy was sort of faltering and inflation was sort of looking well within range. However, this sort of move that we're seeing right now could present a challenge. Nevertheless, we think that the weakness in the economy, I mean, our growth for the last 3 months of last year essentially was zero, and growth for last month was basically 0.1%. So we're seeing really struggle on that growth front. So that struggle on the growth front, we think would likely filter through to sort of moderate inflation, at least in the medium term. Over in Germany, there were federal elections over the weekend, which saw the Conservatives essentially win the election, and the far-right AfD coming in second place with about 20% of the votes. This election really is coming at a very challenging time for Germany, both politically and economically. The German economy slumped in 2023 and in 2024. Further concerns obviously lie ahead, including a focus on exports. Exports have basically continued to falter, and exports have remained a pillar for growth in Europe's largest economy. There's also a house building crisis and difficulties in the auto sector, just on the back of very significant challenge coming from the Chinese auto sector. Really, the coalition would also need to focus on very strong debate at home around, migration. And these would, really prove crucial in determining what happens to Europe's largest economy, particularly at a time where, the security situation in Europe vis-a-vis the Ukraine-Russian war, and also the sort of proposition that President Trump is putting forward, comes to the fore. There was a security conference in Munich last week where, President Trump, through the Vice President, J.D. Vance, is really expecting that Europe would do more. And the leaning of the US now in terms of that war, it's not looking like what Europe would like. So again, if you juxtapose that with all of the economic and political challenges that Europe's largest economy is facing, these are really, really crucial times, for Germany, and we'll continue to keep an eye on the developments in that economy. Over in Japan, headline inflation came in at 4% for January, higher than the 3.6% that we had seen in December, and this was a 2-year high. And this again is sort of further strengthening the case for rate hikes by the BOJ. Recall that the BOJ implemented a rate hike only last month. So with this surge in inflation, it only kind of gives impetus and reinforces the case for the BOJ to continue to hike. I mean, the yen strengthened in the aftermath of the release of these results, and the CPI is also coming after Q4 2024 GDP came in better than expected at 2.8% annualized. Now, analysts are forecasting that the BOJ is going to hike rates in June and in December, and we're also going to see about 2 rate hikes in 2026 and 1 rate hike in 2027. That will bring the terminal rate to about 1.5%. In our local economy, particularly for the fixed income markets, if you look at the treasuries market last week, markets essentially kind of open on a quiet note as, participants essentially awaited, the inflation data from the MBS. And obviously following the release of that data, we saw a very strong demand pick up that drove treasury yields down by about 32 basis points. Also, we had the auction on Wednesday, and we essentially saw sort of cautious trading, in the lead up to that auction. The DMO offered about 700 billion. The demand came in at about 1.7 trillion, eventually sold about 774 billion, with stop rates across board actually declining by 150 and 189 basis points respectively across the 90, 180 and the 364-day paper. Also, that inflation data, kind of spurred some demand that then saw a further 17 basis points decline across core, really, particularly on some select, maturities. If you look at the bond market, it started out, also quiet, essentially looking for, direction in terms of that inflation data. And that inflation data also created some kind of, if you will, bullish sentiments in the market. Nevertheless, in the announcement of the circular preceding the auction that we're looking at today, the removal of the 2035s from the auction today created a really, really strong demand for, that paper that saw it deep to around 18% levels, even at some points, during the week. So like I said earlier, there's a bond auction today, where the DMO is selling about 350 billion 2029s and 2031s. The outcome of this auction will really, really prove crucial in, providing near-term direction to the fixed income market, particularly against the backdrop of what we had seen, last week. So going into this week on the global front, particularly in the US, earnings and also some macro data, particularly that PCE number, will prove crucial in determining what happens to the market. While on our local front, the outcome of the bond auction would really be significant in determining what we see, at least in the near to the medium term, in our local fixed income market. That's pretty much it for our market updates. Thank you very much for your time. We hope that you have a very, very productive week. Thank you.